Good morning, everybody. Welcome to the morning meeting of the Armor Report. Thank you for joining me. I wanted to show you this chart real quick. We're going to talk about this chart right here. This is the S&P going back to December of 2018. So we're going to hop into that discussion in a minute. Just wanted to go over thoughts on yesterday's Fed actions, what it means for the Armor Report, what it means for our portfolios. Just kind of cut through all the noise and just execute what the information is revealing to us. So risk monitor went red. Armor swing strategy for the SPY is red. We go into the CPI and the Fed meeting in max cash positions, and the market is going lower. So that's the bottom line for the Armor Report. Conservative portfolios, you're carrying tons of cash. You're just getting out of this year. There's nothing to do. You're waiting for the next signal to put capital to work in indexes and ETFs. Okay. I'm going to try to help you guys out more as much as I can going into 2023 about how to use the Armor information. Okay. You have to determine what type of investor you want to be, what kind of portfolio you're running, how aggressive you want to be. You're the risk manager of your own assets. Okay. So when I add stocks and investments to the portfolios, the object there is not for you to buy everything, right? I don't know you. I don't know your risk tolerance. I don't know the goals. I don't know what you're doing, right? So this is not, quote, investment advice. This is how I run my own personal portfolio. Then what you do is take the information, say, okay, what type of portfolio am I running? How do I want to structure it? So to help you understand, and what I do for capital that I manage, I've got my conservative capital. I got my aggressive capital. We can skip balanced because that's pretty obvious. Okay. You could do a little of each, right? But for conservative capital, we follow the risk monitor. If the risk monitor is red and the swing strategy is red for the S&P, then we're just carrying max cash. Now, for our aggressive portfolios, we're going to carry max cash, but we're going to expose the portfolio to where we think we can create alpha. So right now we have exposure to precious metals, okay? Silver, gold, and the mining stocks. We try to hedge that periodically. I don't have a hedge on this morning. They're getting knocked down because the dollar is up this morning. But I may hedge that again today. We'll see what happens. So that's the structure of the portfolio. So what happened yesterday? Oh, and of course we have a token position on cannabis, but that shouldn't bother anybody. It's tiny. It's like a place marker, and we're just waiting for the next opportunity to put money to work in cannabis. So they're crushing cannabis into the end of the year for whatever reasons, tax law, selling, whatever. And then coming out of this, I expect the opportunity to make some money in cannabis. So I'm looking for my next opportunity, and I leave it on the spreadsheet as a token position, and then I'll increase the size. I'll let you know that on the spreadsheet when I'm increasing exposure. So what happened yesterday in the Fed meeting? Let's go back to a conversation we had a couple days ago, and maybe even when the risk monitor went red. The problem as I saw it is that the market was priced to perfection. We had this 17% rally off of the low in the S&P. It looked, just doing the eye test, it looked like a classic bear market rally. And the whole market is on one side of the boat, expecting the Fed to raise 50 basis points and talk about where the end of the rate hike cycle is going to be. So I'm going to cut through all the noise of yesterday and just give you the nugget that matters. Okay. This was the comment. This was, and what I want you to do is look at this chart right here, and I'll read you the comment. So here's this bear market rally that led to a collapse. Here's the next bear market rally, okay? So what was the comment that the Fed made, just to go through and cut through all the noise? The Fed said this, ready? This was the comment that sank the market. Fed rate hikes have not been felt yet, but we have more to do. Policymakers need substantially more evidence to have confidence that inflation is on a sustained downward path. That's it. Those are the comments from Chairman Powell that wrecked the market, because the market was priced to perfection. In order to break out of the bear market downtrend, you needed the Fed to say, we're pleased with what's happening. We see the end of this, blah, blah, blah. You know, the market was pricing in rate cuts at the end of 2023. I mean, Powell keeps saying he's not going to do it, and the market doesn't believe it. I mean, at some point, market wakes up and believes it. Big picture macro thought, when the market wakes up and believes it, if Powell does what he says he's going to do, we are looking at stagflation. Precious metals should outperform, and everything else is going to be very difficult to make money in. We'll have another year in 2023 like 2022, which is a lot of whipsawing around an overall downtrend. Okay? And if that's the case, following the risk monitor closely will be very important. Owning indexes and ETFs to get rid of individual stock risk will cut risk exposure. It's a good way to manage risk, you know, and being a lot quicker on booking profits. Get a position on, it pops, take some off the top, raise the stop to break even. That has to be the strategy until further notice, because the path Powell is taking us down is one that's going to lead to stagflation or worse, a really ugly recession. Okay. So, on top of all that, so we have priced to perfection, right? Because the market rallied right up into all this news. And now we look at the comments from Spot Gamma to start putting the pieces together of what could be an ugly end of December. Let's put some pieces together. According to Spot Gamma, now this is really interesting because I've been reading about put-call ratios. Okay, you're seeing people talk about, oh, how high the put-call ratio is. People who are quoting that don't understand the impact of zero-dated options. Over the last 6 months, it's completely changed the playing field of how to understand option behavior, and we're still trying to figure it out. It's a massive casino. It's huge, 45-50% of volume occurring day of that expires that day or the next day. That's not predictive of people's opinions. So when you say the put call ratio is blah, 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 if all of those puts expire tomorrow, it really isn't people positioning to protect. So there is no protection. Spot Gamma says we go below 3,900. It's like trap door. There's no protection. Nobody's hedged. And what's really interesting is that they have their own proprietary measure that I think is a lot better than the put call ratio. And it's the exact opposite of the put call ratio. It's at a level right now, which is stunning to them, that would suggest the market's at all-time highs, meaning nobody's hedging. That there's a total lack of put hedges. This is why if we go below 3,900, it's like a trap door, or 390 on the SPY. Now, the ARM report, I've been saying to you there, we're in a range between 390 and 403 on the S&P, 390 and 403. If we close the week below 390, I think the trap door is opened. I think the bull trap that I talked about 2 days ago has been sprung, and I think the market goes a lot lower. Until we get below 390, that's not a prediction. I'm just saying, hey, if we get there, then I think, right? So I don't know if we're going to get there or not. And we may not get there today. Market's going to open down today, over 1%, but there's massive, and this is the largest options expiration of the year, and almost all of it's focused at 4,000 on SPX, 400 roughly on the S&P, SPY. So any destruction today, you would expect a mean reversion before the end of the day into tomorrow morning when all these options expire. And then maybe at the end of tomorrow. And this is why I've been saying the weekly close is more important than anything else going on this week. So we'll see what happens. And I'm happy to get long. I don't want you to think, oh, I have to be bearish. I don't have to be bearish. The risk monitor goes green, I'll put money to work, right? But I'm just looking at the setup right now. It is eerily similar to what happened in December of 2018, which was the last time the Fed was raising rates and reducing liquidity. And I submit to you that that year was not even close to as aggressive as what the Fed's doing now. Okay? And that's why I wanted to share with you this chart. So this is the S&P SPY, and this right here is December of 2018. I want to just show you that. We talked about it a couple weeks ago. And I want to show you that because we are programmed to believe the market has to go up in December. I don't know about you, but I know I am. I expect it to go up in December. It goes up every year in December. The Stock Traders Almanac tells you it goes up in December percentage-wise. You know, there's a Christmas rally. Everybody loves to talk about it on CNBC. Okay, it's a thin market, so it's easy to manipulate markets higher. And at the end of the year, fund managers want their portfolio to look as good as possible, right? So they can easily throw some money and mark up parts of their portfolio to make it look good at the end of the year. This is the kind of shenanigans that happen all the time. And so you get a situation where nobody owns puts below 3,900. Everybody expects the market to go up in December. Yet the Fed's reducing liquidity. And this is the thing that bothered me the most about the Fed meeting. I read to you the comments that tanked the market, but what really concerns me is the comment that the Fed is going to increase the pace of balance sheet reduction. They're getting rid of mortgage-backed securities. Who's going to buy it in the vacuum? This is why I want to be short, try to find my way into it. I don't know when I'm going to do this again. I cleared the decks of my shorts in front of this week, but the regional bank stocks look god awful. This is the chart of regional banks. It's a head and shoulders top on regional banks. We know that Blackstone, and they're not alone, has problems with their REITs. People can't get money out. They're going to wait and sell their real estate at higher prices, they say. They don't want to do it right now. Yeah, good luck with that, with the Fed dumping a bunch of mortgage-backed securities on the market. So I just wanted to, it's not a prediction. I don't know. The market could easily levitate. Normally the market levitates in December. But everybody's on that side of the boat. Nobody's protecting against it. Yet the Fed is telling you they're doing negative things to the market. And there's a trapdoor below 3,900. And so for today's morning meeting, I wanted you to be aware of that. So if we see that break, you're not a deer in the headlights staring at it saying, well, maybe, blah, blah, blah. No, maybe. Protect capital first. We'll capture upside later. ARMR report stands for Algorithmic Risk Management Research. We got to manage risk first. And the risk below 3,900 gets ugly. And taking a look at that chart shows you that December can be a trap door, because the fact that it's thin, there's a lot of portfolio managers leave the desk in the last 2 weeks of the month. The last 2 weeks of the year, they leave the desk. They're done. They close the books. And they take a 2-week vacation. So just as easy it is to manipulate markets up in that thin environment, if it goes the other way, well, there's just nobody around to support it, and then boom. Okay, so just be aware of that. I know as armrInsiders, you're already in a position where you should be carrying tons of cash, so you should be protected, right? But I just want you to be aware of if this starts happening, just be careful. Okay. So those are my thoughts for today. Is there anything I missed here? I don't think so. No, that was my focus for today. I just wanted to share those thoughts with you. Make sure you're aware of that chart. So if you see it unfolding, you react accordingly. The only exposure I've got right now is precious metals, and if they're going to get wrecked today, I might reduce that exposure. We'll have to see. I might put on some dust. I don't know exactly what I'm going to do in here, as it's a gap down. So I'm going to have to be patient and then see how I want to play it. But conservative portfolios, I'm not going to be getting short. I'm just going to sit in cash. I'm going to collect my 4% plus yield in treasury notes, and wait for the next risk on green. Whenever that shows up, I'll put capital to work. All right. In the meantime, we're working on research. We're working on our whiteboard. There's a highlight in IBD about, which I thought was fairly interesting, about the solar stocks look pretty good. So, we can take a look at those again. There's TAN, which is, holding up fairly well in a tough market. And I think the highlight chart pattern in that group's got to be array. That looks really good. So maybe we'll do some research there today, see if that should be on top of our whiteboard. I think Lena brought this to the table yesterday, and I have to get past my distaste for the vaccine and the whole argument and all that, and just look at the facts. That's a fantastic breakout of Moderna. And the reason is that all of the vaccine hysteria is out of the stock. And what's really happened to Moderna and BNTX and Pfizer to a lesser extent, is that 5 years worth of required testing by the FDA was condensed into like 5 months in order to get out the COVID vaccine, right? And so now they're able to show efficacy, and they can broaden out their portfolio, and they're doing that now with cancer research. It's very interesting. So I'm going to listen to that conference call too, and we've added that to the whiteboard as work in progress. We may be moving it over to a power play if the story we hear on the call today is as bullish as I think it may be, explaining that breakout right there. Okay. So anyway, we still do the research, we do the work, we get risk monitor green, we know where to go. In the meantime, we protect capital, and we're patient. I look forward to working with you all on the live desk. We'll get that started at 9:25. Have a safe and successful trading session. Take care, guys.